Fintech lending was supposed to be the bridge that would enable entrepreneurs, small businesses, and even individuals across India to get access to much needed credit to build businesses. For millions of these companies and even individuals who are seeking a personal loan and would otherwise not qualify for them, usually because they were unsecured, these new age financial institutions were the great hope and sources of credit. Then in October last year, the RBI, like it usually seems to do these days, suddenly swept in and took action. It halted the loan disbursement activities of four NBFCs: Asirvad Micro Finance Limited, Arohan Financial Services Limited, DMI Finance Private Limited, and Navi Finserv Limited. In fact, between the time we recorded this episode to when we released it, the RBI had lifted restrictions from one of these companies, Navi Finserv. But why did the RBI do this? Well, there are some hints. Here are two quotes from the RBI about why they did this. Quote, "Deviations were observed in respect to income recognition and asset classification norms, resulting in evergreening of loans, conduct of gold loan portfolio, mandated disclosure requirements on interest rates and fees, outsourcing of core financial services." End quote. And here's the more interesting quote. Quote, "Unfair and usurious practices continue to be seen during the course of on-site examinations as well as from data collected and analyzed off-site." That's what the RBI said. But what did it not say? Here's what one of our guests, Atish Tanka, hypothesized.
There are a couple of other macroeconomic factors that nobody's talking about, which should worry the RBI, right? In 2021, for instance, when you look at people with a household income of 3 lakhs or less, they typically had up to 28% multiple unsecured loans. By 2023, that 28% had jumped to 72%. So the RBI could be scratching its head and thinking, these people have so many loans, right, across all these households in India. How on earth are they going to pay it back?
Atish is the founder and CEO of AlsoVoice Content Solutions LLP and the former head of City Merchant Services. Regular readers of The Ken might be familiar with Atish. He's written about banking, digital payments, and merchant services as a contributor for The Ken. In fact, just last month, he had written a piece for The Ken asking why RBI is keeping certain companies locked out of the loan market. We've linked the story in the show notes and I really recommend reading it. The other guest who's joining me and my wonderful co-host Rohan for this discussion is Mithun Sundar. Mithun is a leader, growth advisor, and the ex-chief partner officer for Microsoft India. More relevant to this discussion, Mithun used to be the CEO of Lending Cart, one of India's largest lending platforms. In today's discussion, Mithun came in with an operator's perspective about the incentives, ideas, and the realities that lie before banks, fintechs, NBFCs, and the RBI. Throughout our conversation, both Mithun and Atish took the time to get into the details of how digital lending works, why private banks are hesitant to step into the ring and play the game themselves, what's up with sky-high interest rates charged on these loans, and of course, why credit is so important for India to grow and where we are falling short. Let's get started.
Usury. This is a very interesting word, and I actually sat up when the RBI brought it to my attention. That's right, the Reserve Bank of India. What actually happened is on 17th October, slightly over a month from when we are recording, India's Reserve Bank barred four key non-bank players, and one of them is really, I mean, well known, Navi Finserv, which is the fintech launched by Sachin Bansal, formerly of Flipkart, who went all in after Flipkart, and then DMI Finance, Asirvad Micro Finance, and Arohan Financial Services. The RBI barred these four players from dispersing new loans. And it gave reasons. Some of the reasons were, for example, quote unquote, there were failures of material, or there were material supervisory concerns. There was also another one saying they were offering incentives to non-bank salespeople that were purely target driven. I mean, a lot of this stuff was like, but when I sat up was when I read that these institutions were barred because they were charging usurious interest rates, unreasonably high processing fees, and frivolous penalties. Now, the moment I saw usurious interest rates, I was like, wait, what? Because my understanding was the only context in which we ever saw the word usurious used in India was the bad old traditional money lenders. You know, the people to whom India's poor go when they have no option, the traditional money lender. And the traditional money lender has always been the big bad wolf who charges bad, usurious interest rates. And therefore, all of the innovation and work that we've done in the financial services sector and in fintech lending over the last 5-10 years, even more, has been to reduce the power of the usurious money lender. And here we had the RBI banning four very modern regulated entities from giving out loans because they were charging usurious interest rates. So I sat up because for me it was like, wait, how is this possible? And then I decided to kind of go back and read more about what is usurious. And it turns out there is really no definition of what is usurious. In fact, this is a great time for me to ask you, Atish, what is usurious? Because you, just before we were starting to record, you had given me a very interesting historical context of what is usury and what is usurious.
Right. So thanks for that, and thanks for having me on the show.
Thank you. You're
Rohan
our
and Praveen.
first
And
international
hi, Nikhil.
guest because we're recording with you from Singapore.
Now, so usury actually just means the charging of interest. That's all it means. And when somebody says that you're charging a usurious rate, they actually are creating a connotation of that denotation, which means that the interest rate you are charging is too high. Now, this only makes sense if there's a certain definition. That means, have you decided that the maximum you can charge is 29%, the maximum you can charge is 36%, whatever. That number is entirely up to a country, a state, or a monetary authority. In our case, it's the RBI. However, when the RBI accused these four entities of charging usurious rates, the problem is that there's no definition for them. In fact, curiously, the only legislation that exists in India with regard to usury applies to money lenders. Money lenders in many states are told that they cannot charge more than 18%.
Wait, what?
And they nod their
what
heads most
percentage?
sagaciously.
18%
That's
per?
right. 18, 1/8 per annum. And so they nod their head sagaciously and they say, yes, sir. And then they go and charge 180% or maybe 18% a month, right? And unfortunately, because those entities are not regulated, and the RBI, for instance, does not have the wherewithal to actually go in and, stop them from doing this, right? A lot of it is off the books, as you all know. There is no real usurious rate that has been published in India, neither for the scheduled and regulated banks nor for the NBFCs. And in fact, this is the crux of the problem, because the RBI has made an accusation, but it has not given them a ceiling rate. Number one. Number two, even if they were to provide a ceiling rate, the RBI actually has to look into what are the drivers that drives the effective
Adish, I
interest
want you
rate
to
for
hold on.
NBFCs. It has not
We're
done
going
that
deep
either. Yeah.
into
Yeah.
the weeds right now. Let's
Okay.
hold that
Sure,
back,
sure.
right? I want to kind of
Sure.
with the definition of usury. I get your point that usury traditionally, or
Right.
in its origin, meant just charging interest, but over time it essentially meant charging an exorbitant rate of interest. Now the question is, what is an exorbitant rate of interest and other limits? And I was reading up, and various countries around the world do set limits on what is a usurious rate of interest. Many states in the US do, many countries in Europe do. In fact, like you said, there are states in India as well that do set limits on usurious interest rates. Mithun, you're the former CEO of Lending Card. I know it's been a while since you left Lending Card, so I'm not holding you to any operational decisions that they're taking right now. But were you aware, what's your understanding of usury and usurious interest rates in the context of having been the CEO of a lending company?
First of all, again, thank you, Rohan, and thank you, PGK, for having me on, and a pleasure to be speaking with Atish as well. I would first agree with a lot of what Atish said, right? Which is about usury or a usurious rate is a reasonably arbitrarily fixed number, and there is no concrete guideline for anyone operating in the space on this is what you're not allowed to charge. To be honest, when as an NBFC, even the NBFC that I ran, as an NBFC that has come in, what you're asked to do is to be able to do two things. One, find the right target market, run the right controls so your risk is measurable, and then lend in a manner where your business is sustainable across all of your products. Now, if your business has to be sustainable, you need to be able to make whatever that right profit margin is over and above whatever your costs are. Assuming that every company that is, and even the 4 companies that have been banned recently, assuming that they're doing a reasonable job of trying to get their costs under control, whether it's their borrowing costs or their operating cost, and they're doing a reasonable job of figuring out what is their adjusted risk, they will need to charge what they need to do to be able to make the profit. And if what they're charging is very high, then their profits would skyrocket and you'll have 50 more competitors coming in the market. So it's self-correcting in its own way.
That's an important point, which I think bears mentioning, that if we operate in a competed market with clear rules, and there seem to be dozens and dozens of lenders out there in the market today. So if any one entity is charging a significantly higher rate of interest, it stands to common sense that someone else should offer a reasonable interest rates and customers should go to them. That it may or may not happen is something that I want to talk about.
Well, here's the reverse of the question you said, right? If I were to take the unbanked or the underbanked segments in India, lot of new startups, whether they are NBFCs, microfinance institutions, trying to find the right balance of what to lend. However, if you go to the significantly banked population, the folks sitting in the room here, there is a much higher concentration of the number of the main banks who actually hold their sway over here. And so, to be honest, I actually feel it's under-competed and much more commoditized on the actually banked segment. And some of what you're seeing here is a little bit of which lobby is pushing for what. And we can get deeper into it at your player. But for me, as I see it today, the writing's on the wall. The RBI governor spoke, I think, about this thing about 3 months back, about banks in the country struggling because people are overall depositing much lesser. People are spending much more. Where they used to be able to deposit, now it's going into mutual funds, equity markets, debt. They're putting a bunch of... So your total amount of, what they call the ratio of money sitting with the banks on which they give that, 4, 5, 3% interest rate, based on which they can lend, is going down dramatically. So banks are at this point squeezed. And when they see that squeeze is happening, and there's another segment of the market that's actually getting penetrated with a different risk profile, which they are unable to serve because they
unwilling.
Just don't.
Unable or unwilling? We don't know. I think
actually from a
yet,
business model perspective, it would be unable because you've set up costs for a different segment.
So when a bank lends to an NBFC, what is the risk that it bears? Because I understand that when an NBFC borrows money from a bank and lends it further to end consumers, and let's say some percentage of those end consumers don't repay the NBFC, that risk is the NBFC's. I get that, right? So my question is, what's the risk between the bank and the NBFC? If the bank gives to the NBFC at 16%, is there a risk? Can the NBFC pass on some of the delinquencies back to the bank saying my customers didn't pay me, so therefore I'm not paying you?
I guess, I'll let Adish answer, but my guess is that I imagine that the banks will argue that there is a certain risk whether the NBFC can continue to be a going concern. We don't know who they are lending to, etc., etc. Am I correct?
in the practical world, one of the negotiations that happens between the NBFC and the bank you buy is what minimum guarantee do you offer? Like the NBFC, and hence, if it's a zero minimum guarantee, there can be a pass through, and you can actually technically they can still hold
By
risk.
minimum guarantee, what does it mean?
NBFC borrows 10 rupees from the bank. It minimum guarantees the bank back 6 for sure. Or if the charged interest rate is 16%, let's say that's then 11.6 that they have to pay. It minimum says I will at least pay you 9. So that much is secured for the bank. And the remaining, the NBFC could go insolvent in the next 2 months, at which point then, the bank cannot, there is no asset to pick up. I want to add, in your first point itself, Atish, I just wanted to add 2 aspects to this. I think number one is what we also underestimate is, or not underestimate, building on what I had said before, the banks today, your 4.5%, I don't know what was released the prior years, but my assumption is that the actual net borrowing rate for a bank or its cost of capital has been going up year on year because the amount of current account surplus has been going down. People are putting money into other sources. People are saving less. So as a total, and hence they're also borrowing from open capital markets more, my sense is it's going up. So there's a little pressure on the banks. That's one of the... Second piece I wanted to say is, while for the NBFC, they're getting the money from the bank at the 16 to 20% that you said, additionally, there's another operating cost of going and finding customers and doing that higher for an NBFC because the kind of customer they're reaching is sitting somewhere else.
We'll get to that because I think we were also trying to build that layer one by one, right? Like, first layer being banks lend to. And my question was, what's the risk that the banks bear and how do they justify charging 4x their cost of funds?
So to be honest, there's no justification, right? But as Mithun said, there are certain minimum guarantees that are negotiated. After that, it's jam. And I hate to use the word jam, but it's up to you, right?
By jam, you mean literal jam.
Charge and at what rate these people...
Right? It's not an acronym.
I mean literal jam.
It's not Aadhaar or anything like that, right? Because there's a lot of acronyms.
No. I mean literally, right? No, nothing like that, right? So I literally mean jam, right? Because it can be a pure profit play, right? And if you think about it, I'm essentially subleasing an activity to another entity because I am unable, and in some instances, I don't want to take on the hassle of going to tier 3 towns, villages, etc., right? Because their overheads, there's marketing and origination fees, etc. I've given it to these people. They seem to be more efficient. I'm going to charge them a rate. I have a minimum guarantee. And then as long as Mithun said, as long as they don't go insolvent, I earn a very, very handsome profit from the entire operation, right? So just to add to the cost of funds, as we've been talking, there's also risk premium. And that risk premium in the case of an unsecured loan is really around the risk profile of the customer. So if you look at India's CIBIL scores, which run from 300 to 900, 900 being the best CIBIL score you can have. For an unsecured loan, the average bank will not lend to anybody with a score under 720. At most, they'll pull it down to 700, right? That means that hypothetically, 80% of India's population is outside of this. They don't qualify for an unsecured loan from a bank. So now come the NBFCs, and the NBFCs can go to 650, 600. In some instances, if I'm a 21-year-old and I'm just starting out, I may not even have a credit file or a credit score, right? So they may choose to loan to me, etc., right? So NBFCs do carry the risk where banks do not. And so their risk premium and what they factor into that effective interest rate tends to be a lot higher. So where, let's say, a bank's risk premium up to 720 is between 4 to 6% on an unsecured loan. And these are customers typically about whom I know quite a bit. There's a lot of credit history, etc. When it comes to the average NBFC, it's never less than 12%, 12 to 14%, right? So that also factors into that EIC, that effective interest rate. And then, as Mithun was talking about, you have marketing and originating costs, right? So those marketing and origination costs for banks are about, say, 3 to 4%. For NBFCs, it's about 5 to 7%. You also have operating costs because these guys are going into villages, they're going into hearts, they're having to go and find these customers. It tends to be closer to about, say, 10%. For a bank, it tends to be about 6 to 8%. Strangely, the overall profit expectation is about the same.
So I have a question. I understood all of this now. Okay, fundamentally what I think Atish did a very good summary, but this thing is that you're basically saying that interest rates depend on who is lending and who are you lending to. Like fundamentally, it's that between a bank and NBFC and the kind of the person that you're lending to, and that there's a certain spread associated with that. So then let me pose this question. I don't know, maybe I'm getting ahead of Rohin because in this podcast, but here's my question. What then is the motivation for the RBI to do this? Like, do we believe that the RBI is,
Wait. Motivation? Should regulators have motivation?
I mean,
I
surely,
believe
right?
that it's a good question to ask. It's a good wording also.
No.
I mean, if I take a step back and go first principle on it,
Yeah.
I believe, I mean, it's our country and there's always checks and balances. And my sense is that's why the first point I made was banks are struggling today. The lobby is strong. So I cannot discount the fact that that lobby would push to protect some of the rents that they used to do. They're going to have to evolve models. They're going digital. You've seen this HDFC Pays app is now in all of our IPL and the cricket games. You see them, advertising it. So they're doing what they can, but they're also seeing that the share is going away with other people. So there is one that's a lobby question.
Okay.
Second is just pure, and so there is a motivation. But even if you remove that, as a regulator, you will always be doing slightly arbitrary checks and balances. You can't assume perfect competition. They may have a point of view that, hey, listen, I'm seeing a lot of fast and loose in how these loans are being underwritten. And is it a lot? Is it a little? That's always going to be a debatable question, right? I can sense that it is. So they're pushing it a little further back down this thing before they allow it to expand. Maybe they're at a place where they feel, and again, it's a hypothesis, right?
Of course, this is all a
There are 60 million SMEs in the country. Technically, about 500,000 of them get like actual access to capital. So that leaves 5.5 million who don't.
Yep.
Even if you haircut the number by half, there's still like 2 million who don't, right? Now, the government and the RBI has a, I mean, it's one of their motivations is to make sure that they are getting banked.
Correct.
Maybe they felt the expansion was pretty quick in the last 6 months and they're sort of making sure that the regulation. So you can have hypotheses of this sort. I do believe the biggest hypothesis at this point for me is the strength of the banking sector asking for regulation in a part of the market that they're getting shortchanged in, while their original market is also sort of compressing and getting more challenging.
I want to talk about the banking sector. Sorry, Atish. I want to come back to a point that you made, and I think all of us seem to, at least the two of you who are the experts, seem to agree that the biggest jump in the effective interest rates that is charged to a consumer happens because cost of funds is very high. And we discussed that banks on average have cost of funds of, let's say, 4.5%. And when they lend to NBFCs, it seems to jump to, let's say, 16 to 20% or something like that. Now, help me understand this. As a layperson, India is a fairly developed, mature, and competitive and well-penetrated financial services market, right? We have lots of banks. We have lots of NBFCs. We have lots of lenders. So why does, in any market, whenever significant profit margins, to quote Jeff Bezos,
Your margin is my
margin
opportunity.
is my opportunity, right? So if somebody whose cost of funds is 4.5% is lending at 16 to 20%, and that is essentially pushing up the cost for the eventual borrowers, and that's a problem. My question is, in a well-functioning market, why isn't someone else, another bank, coming and saying, you know what, the 16 to 20% is too high, I'm just going to charge 10%. And that's competition. And then another bank will say, hey, wait a minute, they're charging 10%. I'll offer at 8% because I think that's okay. So why isn't that happening? Why are such significantly exorbitant rates, perhaps even usurious rates, sustaining themselves from banks to NBFCs in a well-functioning, well-regulated, competitive market?
So, till about 2 years ago, there was a fair amount of foreign investment coming into fintechs. So, when the foreign investment was coming into fintechs, actually the rate at which they were being able to borrow money was much lower. Number one, that has begun to dry up. Number two, the only other options they have now are either to raise debt, which is almost impossible, or else to borrow from banks. Now, banks, because of the high interest rate environment in India today, are finding it very difficult to actually push out corporate loans. In fact, even personal loans, for the most part, to people like us, have dried up considerably. So now the only option is we need to go out to those who are underbanked. I don't want to say unbanked, but underbanked. But for banks, this is a big headache, right? So they would rather give it to NBFCs because NBFCs are far more suited to doing this than they are. Except in those instances, such as where HDFC has its own HDB, which is running a similar show. Now, while HDFC will be willing to do some level of transfer pricing with HDB, HDFC will not be willing to do the same to Navi Finserv because there would be the risk of cannibalization. So there will always be a differential between giving to your own microfinance institution owned by you or your NBFC
Is
and
that
giving
allowed?
it to a third party.
Is that allowed, Atish? Because
Yes,
my
of course.
understanding,
Of course
I'm not
it's
a
allowed.
lawyer, but in general, don't you have to do some kind of arm's length pricing even when you do transfer pricing with an entity which you're related to? Don't you have to
Yes,
offer the
but
same or similar rates to others as well?
so again, your ability to offer the same or similar rates is actually linked to your overall history and your ability to pay back and the profile of customer you are going after. The sort of customer that HDB will go after is also very different, not necessarily the same, than what, let's say, a smaller fintech or smaller NBFC will go after, right? And now the last thing is, at the end of the day, for any loan that the bank makes, the interest income must be a positive, as Mithun said, 2 to 4%, right? Now, if I fear that by giving this money to Navi Finserv or to DMI Financial, there's a chance in this environment, right, that the actual default rate goes into double digits or hits 9% or 10%, I need to be able to absorb that despite any guarantees I may have got and still make my 2 to 3%. So it's a combination of all these factors, in addition to the fact that a bank, like any other entity, is interested in profit maximization, which drives up the rate at which they lend to a third party. Right? So
Yeah, let me add.
I'm trying to just give you the 2-minute version, right? And that's it. Yeah, go ahead, please.
No, two points to add. I think first, fully in agreement to what Atish said. My history with the industry being about 3 years old, it is right that I've seen interest. We've been able to, lending card could borrow at lower than 16%, at like 12, 13. Still, it's not at 4 or 5%, right? So the market has changed in terms of what's available and what's not. And at this point, it may be 16. The reason the banks factor in a higher risk is also because these companies are expanding rapidly. So their denominator is growing dramatically. Every month, you're doing 1.3x, 1.4x the loans that you did in the prior month or something of that sort. And hence, you always are only having maybe a few months of cash available with you. So should default climb up at any point in time, and these are loans you've given out 3 years back, 4 years back, should default climb at any point in time or even a year back, you have very limited ability to be able to take money out of the NBFC outside what they've given as a minimum guarantee, which they will need to hold in reserve or something of that sort. You'll have very minimal ability to be able to take it out. And hence, they are factoring that risk. And I want 2 to 4%. I see a 30% chance of them probably defaulting. I'm going to do 2 to 4 multiplied by 1.3 or 1.5.
What you just listened to was just a small part of the discussion that we had with Atish and Mithun. If you want to catch up on the full episode right now, you can do that by signing up for a premium subscription to the Ken, which in addition to 2x2 will also give you access to all of our long form stories, premium newsletters and visual stories. Or if you're just interested in getting access to 2x2, you can access it, including this one, by subscribing to it on Apple Podcasts. This episode was produced and researched by Hari Krishna. Rajiv Sian, our resident sound engineer, did the mixing and mastering for this episode.
And if you haven't rated us yet on your favorite podcast platform, it would mean a lot to us if you could.